Welcome to my channel. I'm Scott, and if you want to catch my newest video, I post one every day at 8 a.m. In this video, I am going to walk you through the process of valuing ONEOK stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. ONEOK is a Fortune 500 company based in Tulsa, Oklahoma. It was founded in 1906. The company engages in gathering, processing, fractionating, transporting, storing, and marketing of natural gas. In 2007, Fortune magazine named ONEOK the most admired company in the energy industry. Let's get started with the model. This is a large cap company, 18.5 billion market cap. They're trading at $41.57 a share, and they have 444 million shares outstanding. Let's look at the financials. The way you value a company is you forecast the future free cash flows and then you discount that number back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. The company has positive free cash flow in 2017 and 18, but negative in 2019 and the trailing 12 months. Net income is the profit and loss on the income statement. It's revenue minus expenses, and they have positive net income every year. Their revenue seems to be decreasing. It was $12.2 billion in 2017, then it dropped to $8.6 billion. The main reason for the decrease was the low oil prices. This is the company's income statement. The top line is the revenue. Below that is the cost of revenue. The difference between those two numbers is the gross profit. Even though their revenue was lower in 2020 relative to prior years, they had much lower cost of revenue, so their gross profit was in line with prior years. Their operating expenses were $900 million, so their operating income was $1.9 billion. So they seem to be operating a more efficient business in the trailing 12 months relative to prior years. They have a lot of debt, so they have a pretty big interest payment, $665 million. They also have a decent amount in other income and expenses, but they do have positive net income every single year. This is the statement of cash flows. The top line is operating cash flow, and they have pretty healthy operating cash flow each year, $1.3 billion to $2.2 billion. And the way you calculate free cash flow, it's operating cash flow minus CapEx. CapEx is investments in property, plant, and equipment. And they do have negative free cash flow in the trailing 12 months in 2019. Although it's not good to have negative free cash flow, the more important thing is the company has positive operating cash flow. The idea is that the investment in CapEx will lead to greater operating cash flow in the future. The company issues a lot of stock to run their business, $500 million in 2017, $1.2 billion, $29 million, and then $1 billion. And they issue even more debt, $1.2 billion, $1.8 billion, $4.2 billion, and $3.2 billion. So even though the company has positive operating cash flow, they're investing so much in their business. Plus, when companies acquire other businesses, they tend to go into debt to do that. The most important part of the business is operating cash flow, because if you don't have positive operating cash flow, you won't be a viable business for long. It's okay if startups have negative operating cash flow. Sometimes mature companies have negative operating cash flow, but only for maybe a year or two, not for a long period of time. So the company had $625 million of net income, but $1.7 billion of operating cash flow, because they have a lot of non-cash items on the income statement. They had $550 million of depreciation, and this is a non-cash item. They didn't actually pay $550 million. They spent the money years ago when they bought the equipment, but the purpose of depreciation is spreading the value of the asset over many periods. They also had $641 million in impairments. Also, that was money spent years ago, but they're passing through the loss now on the income statement, so you have to add it back on the statement of cash flows. Let's look at a capital structure. They have $6.2 billion of equity, $12.7 billion of debt, and net debt is the same amount, $12.7 billion. They pay 5.2% interest on their debt, and cost of debt is 4%. To calculate cost of debt, it's interest rate times 1 minus the effective tax rate. And 67% of that capital structure is debt, so they are a bit leveraged. 33% is equity. Cost of equity is 17.6%. And to calculate cost of equity, we need the beta. That's how volatile the stock is relative to the market. And their beta is 2, so the stock moves 2 times the market. And their WACC is 8.5%, which is a blend of the cost of debt and cost of equity. And that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimate a terminal value, which is all cash flows past year 4, that's $14.2 billion. We discounted those numbers back to today using the weighted average cost of capital, We get a value of the company of $14.4 billion. We divide that by 444 million shares. And we get a calculated stock price of $32. They're trading at $42, so they're trading at a 29% premium. It's a sell according to the model. Simply Wall Street values the company at $47, so they're saying it's undervalued. They're in the opposite direction as me. This is where the stock has been trading at the past few years. So you can see for 4 straight years it was on an uphill climb and then dropped off a cliff in March. It has come up a little bit since the bottom, but not much, so it seems like it's trading at a really big discount relative to its all-time high. The stock has decreased in price 43% in the last 52 weeks. That's much worse than the S&P 500, which increased 15% in the same period. It has a really wide 52-week range, a low of $12 and a high of $78. Almost all the shares are floating, which means investors have access to the shares. The higher the percentage of float, the better it is for the investor. And only 2.5% of the shares on float are shorted. That's a pretty low short percentage. And 2/3 of the shares are held by institutions. Institutions are considered experts, so the higher percentage held by institutions, the better. The company pays a pretty nice dividend, 9%, and they've been raising their dividend throughout the years from 62 cents to 94 cents. They have a really high payout ratio, 266%, so they pay 2.5 times their net income out in dividends. This can happen with accrual accounting. Since there are a lot of non-cash items on the income statement, the payout ratio could look crazy like this. The original name of the company was Oklahoma Natural Gas, and it was founded in 1906. In 1980, ONG reorganized as a holding company and renamed it to ONEOK. Oklahoma Natural Gas became ONEOK's leading subsidiary. In 1996, ONEOK acquired Western Resources, now named Westar Energy. In 2003, it acquired Southern Union Gas. In 2014, ONEOK spun off these companies into their own publicly traded entities. ONEOK used to be an MLP, but it changed to a C Corp in 2017. Just last week, Morgan Stanley maintained their sell rating on ONEOK at $37 a share. The average estimate for 14 analysts is $36. The range is $26 to $45. So I'm on the low end of that range. I'm at $32. The company has 18,900 miles of natural gas pipelines. It has 10 natural gas processing plants in the Mid-Continent region and 12 processing plants in the Rocky Mountain region. The company can produce 14,000 barrels a day of natural gas liquid fractionation. It also has 8,400 miles of gathering pipelines and 5,500 miles of FERC-regulated pipelines. Also 4,500 miles of distribution pipelines and 4,500 miles of FERC-regulated pipelines. It has 8 natural gas liquid fractionators. This is a list of the company's top shareholders. Vanguard owns 11.5%, BlackRock 9%, then State Street, BNY Mellon, Geode Capital, Tortoise Capital, and Charles Schwab. And for Tortoise Capital, ONEOK is 4% of their entire portfolio. The company trades on the New York Stock Exchange, the Bourse in Germany, the London Stock Exchange, the Italian Stock Exchange, and the Sao Paulo Stock Exchange. The average age of the leadership team is 56 years, and the average tenure is 4.5 years. The president has been with the company for 7 years, and the compensation package is $11 million. Let's look at the financial ratios. The average PE is 12.4, the median is 14.9. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They're at 29.6, so investors are paying about $30 for $1 of earnings, which is worse than the median and average. Price to sales is stock price over sales per share. They're at 2.1, so they're doing better than the median and average. Price to book is stock price over book value per share. They're at 3.0, so they're between the median and average. The way you calculate book value, it's equity over shares outstanding. Equity is assets minus liabilities in the balance sheet, and their tangible equity is $5.3 billion. So they have about $1 billion of intangible assets on their balance sheet. Interest coverage ratio is EBIT over interest expense, so they can cover their interest payments almost 3 times with their EBIT. ROE is net income over equity. They're at 10%, so they're between the median and average. Current ratio is current assets over current liabilities. They're at 0.7, so they cannot cover their current liabilities. Their current assets are $20 million of cash, $830 million of receivables, and $506 million of inventory. So their free cash flow in the trailing 12 months was negative $1.3 billion, and they have negative $550 million of working capital. And not much of their current assets is cash. It's mostly tied up into receivables and inventory. So it looks like they're going to need to take on more debt to run their business next year. The best way to look at ratios to compare them to similar companies, I've done videos of 43 companies in the oil and gas midstream industry. This is just some of them. ONEOK is right here. And if they have a number in red, that means they're worse than the average. If they have a number in green, they're better than the average. So they're worse in PE because the average is so low, probably because there's so many negatives which are dragging down the average. They're a little higher in price of sales, a little lower in price to book. Current ratio they're not doing well in. ROE they're a little better than average. And in debt they're a little higher than average. And they're much bigger than the average company, more than double the average market cap. And their dividend is lower than average. They only pay a 9% dividend compared to the average in the industry of 10.35%. So to summarize, I do have them trading at a 29% premium. If the stock price comes down or oil prices go up a lot, I think this company may be undervalued again. But at this point, it seems like they're trading at a premium. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking the link in the description below. Thanks for watching.